Welcome to Talk Tickers, your deep dive into earnings calls.
Hello.
Today, we're digging into Pure Storage. They just released their first quarter results for fiscal 2026.
Yeah, quite a bit in there. Seems like a solid start to their year, especially considering, the macro climate they mentioned.
Right, the dynamic macro environment. So, despite that, they still managed double-digit growth.
They did. Top line revenue was $779 million.
Okay.
That's up 12% compared to last year.
Not bad at all in this environment. How about profitability?
Operating profit came in at $83 million,
Okay.
which gives them an operating margin of 10.6%. They said this was pretty much in line with what they expected.
Even with some headwinds. I thought I saw something about currency.
Yeah, exactly. They mentioned about $8 million in extra operating costs just from the weaker U.S. dollar impacting foreign currency expenses. So hitting their target despite that is decent.
Gotcha. So what's really driving the performance then? Is it just the core storage tech?
That's part of it, their differentiated portfolio. But they specifically highlighted strong demand for their e-family solutions.
Those are the ones focused on capacity and efficiency, right?
That's right. But I think the bigger story maybe is the subscription side.
Yes, the storage as a service push.
Yeah.
How do those numbers look?
Really strong. The total contract value, TCV, for those solutions, it jumped 70%.
70?
Yeah, 70% year over year. That landed at $95 million for the quarter.
And that's a mix of big and small deals.
Seems like it. They mentioned both large evergreen one deals, the ones over $5 million, but also good velocity in smaller transactions too. So broad-based momentum there.
The 70% TCV growth, that really feels significant. Shows the model's catching on.
Absolutely. And you see it reflected in the recurring revenue metrics too.
Like the subscription services revenue itself.
Exactly. That hit $406 million.
Okay.
Which is up 17% year over year. And importantly, that's now more than half their total revenue.
Over 50% from subscriptions. That's a big milestone. Changes the whole profile.
Definitely. More predictable revenue. And it ties into their ARR, annual recurring revenue.
Right. Where did ARR land?
Grew 18% to $1.7 billion.
Okay, $1.7 billion.
Right.
And the RPO, remaining performance obligations.
Also strong growth there, up 17% to $2.7 billion total.
Did they break down that RPO further? Like how much is actual subscription stuff?
They did. The part that's specifically storage as a service and renewals of their evergreen subscriptions, that portion grew 18%.
So confirmation that the core recurring business is really expanding nicely.
Yeah, it looks healthy.
How about geographically? Any standout regions?
Well, the U.S. is still the biggest chunk, $531 million, growing 9%.
Right.
But international growth was actually stronger, 21% growth, reaching $248 million.
Interesting. That international acceleration is something to maybe keep an eye on.
For sure. And they're still adding customers. Added 235 new ones this quarter.
Bringing their total penetration
up to 62% of the Fortune 500 now. So still making inroads there.
Let's talk margins. You mentioned operating margin, but what about gross margins?
Total gross margin actually improved sequentially, came in at 70.9%.
Nice. Driven by?
Well, the subscription services margin is, consistently high, 77.2%.
Wow.
But product margin saw a good bump too, up to 64%. That helps the overall mix.
Okay, so healthy margins overall and the balance sheet. Still looking strong?
Very strong. They've got $1.6 billion in cash and investments.
And cash flow.
Operating cash flow is really good this quarter, $284 million.
Solid. Were they returning cash to shareholders? Buybacks?
Yep. Bought back $120 million worth of shares.
Okay.
And they still have about $152 million left on their current authorization.
All right, let's pivot to the outlook. Guidance. This is where that macro uncertainty comes back in, right?
It is. For the full fiscal year, 2026, they're actually reiterating their previous guidance for revenue and operating margin.
Okay, holding firm for the year.
But they definitely made a point of saying they see, elevated macroeconomic uncertainties, especially persisting into the second half, less visibility later on.
Got it. So hold the year, but flag H2. What about the immediate next quarter, Q2?
For Q2, they're guiding revenue to $845 million.
Which represents what kind of growth?
That would be about 10.6% year over year growth. So similar pace to Q1.
And Q2 operating profit. Margin.
They expect operating profit of $125 million. That translates to an operating margin target of 14.8%.
So sequential step up in margin from Q1's 10.6%.
Exactly. They see margin expansion next quarter.
Okay. Beyond the core numbers, there was a lot on the call about strategy, partnerships, new products. What stood out?
Well, AI was a huge theme. They talked about getting wins across different types of AI workloads.
Like what specifically?
Everything from, the big public and private GPU farms to enterprise stuff like inference using RAG retrieval augmented generation.
And they launched a new product for that space.
Yeah, FlashBlade XA. It's aimed squarely at the ultra-high performance AI and HPC market.
How's it different?
It's got a new disaggregated architecture designed specifically for these massive GPU clusters. They think it'll be the top performer when it ships later this quarter. It's a big bet on AI infrastructure needs.
Makes sense. Another big theme seemed to be modernizing IT. Yeah, especially around virtualization. That whole VMware situation is shaking things up.
Definitely. And Pure seems to be positioning itself well there. They announced a big partnership with Nutanix.
Oh, interesting. To do what?
Basically integrate the Nutanix cloud platform with Pure Storage. The idea is to offer a modern, scalable alternative for virtualized environments, especially for demanding workloads. That's expected later this year.
And Nutanix is a key player in that sort of modern HCI and virtualization space.
Exactly. And they're also working with Microsoft.
On the VMware migration front.
Yes. Integrating their cloud block store with Azure VMware solution, AVS.
Okay.
It's in public beta now, GA later this year. The goal is to make it easier for customers to just lift and shift their existing VMware stuff into Azure using Pure Storage underneath, addressing a clear pain point.
And these aren't just press releases, right? They mentioned actual customer wins based on this platform approach.
They did. Cited a global car maker using them to unify containers and VMs at manufacturing sites, cutting costs, and a healthcare company that reduced complexity and cost by moving to Pure. So, tangible benefits.
What about the Meta deal, the big hyperscale collaboration? Any updates?
Yeah, they said production validation testing is on schedule.
Okay.
Still on track to deliver that 1 to 2 exabytes they talked about in the second half of this year.
And building the supply chain for that kind of scale?
Seems so. They announced a new collaboration with SK Hynix, developing flash specifically for energy-efficient hyperscale needs.
Adding to existing partnerships, right?
Yeah, they already work with Kioxia and Micron, so lining up their ducks with the key flash vendors for that hyperscale market push.
Let's circle back to that H2 uncertainty. Did they give any more color on potential impacts like tariffs or anything?
They acknowledged less visibility, mentioned potential tariffs as part of the general macro dynamics.
But how would they handle that? Pass costs on?
Interestingly, no. They emphasized that their Evergreen One model gives customers price predictability. And they stated pretty clearly that any potential tariff costs would be absorbed internally through operational efficiencies and what they called back-end lifecycle economics. Basically, they promised not to raise customer subscription rates because of tariffs.
That's a strong commitment. Shows confidence in their model, I guess.
It does.
How did the quarter itself feel in terms of timing? Was it all crammed at the end?
They actually said linearity was pretty typical, started strong, stayed strong through April, maybe even a bit better than usual, which helped that strong operating cash flow number.
Okay. One last thing, there was an executive change announced.
That's right. The CFO, Kevin Chrysler, is leaving after about 5 years, going to a new opportunity.
Is he leaving immediately?
No, he's staying on until they find a replacement to ensure a smooth transition. But yeah, that's definitely something the market will watch.
Okay, definitely. Right, let's shift gears. It's time for our This Is Not Financial Advice segment.
All right, where we spin a perhaps outrageous but plausible trade idea based only on what we heard in this earnings call.
So, considering everything we've discussed, the solid Q1, that accelerating subscription TCV growth,
the strategic wins in AI with FlashBlade XA and in modern virtualization with Nutanix and Microsoft.
plus the reiterated full-year guide, even with those H2 warnings.
And importantly, how they described the Meta deal revenue for this year. They called it diminutive, based on a licensing fee model, not the full hardware value yet.
Okay, putting all that together, here's the pitch.
The idea, go long Pure Storage.
The thinking is the market might be overly focused on the general macro clouds hanging over tech.
And maybe misunderstanding that Meta deal ramp. Seeing low initial revenue this year and thinking it's not progressing or the opportunity is smaller than it might be long term. Like the call said, maybe missing the forest for the trees.
Because the underlying business, the core momentum, seems pretty strong, wouldn't you say?
It does. You've got secular trends like subscription adoption playing right into their model. You have clear demand drivers in AI where they're launching specific products.
And that virtualization shift, where their platform approach and partnerships seem well-timed. They seem to be taking share even now.
And that Meta deal, minimal revenue this year because it's structured as this initial licensing fee based on capacity deployment.
Right, not full system sales yet.
But maybe that's just strategic positioning. Like they're building the capability, proving it out, setting the stage for potentially much larger hyperscaler deals down the road. It's like R&D investment disguised as very small early revenue.
And meanwhile, margins are strong, expected to improve even next quarter. Shows operational leverage.
So the argument is you've got potentially undervalued fundamental strength and good strategic positioning in growth areas.
Compared to maybe overblown fears about near-term macro risks and a potentially misunderstood hyperscale story that's just starting.
Of course, let's be crystal clear.
This is strictly for informational purposes. It is absolutely not financial advice. Always do your own research.
Definitely. So to wrap up the key takeaways from the call, Pure Storage put up a solid Q1, double-digit growth.
That subscription momentum, especially the 70% TCV jump, really stands out.
Big strategic progress in AI and modern virtualization, backed by partnerships and product launches.
And they held their full-year guide, despite flagging that H2 macro uncertainty.
We hope this run-through helps you make sense of it all in your own analysis.
It maybe leaves you with a couple of things to think about, like how big is this shift to modern virtualization really? How will it reshape the data center landscape?
And what does that mean for storage players like Pure who seem positioned to enable it?
And also thinking about that Meta deal. How much future hyperscale potential is actually priced into Pure stock today, especially given they've been so clear that the initial revenue impact this year is tiny?
Food for thought.